Hey there, everybody, and welcome to Yahoo Finance Live. I'm Dave Briggs alongside Jared Blickery. Shauna has the day off. Happy Cyber Monday. Appreciate you joining us, taking a minute out of your shopping. Let's get you up to speed on the market action today. All indices in the red, Jared. Why?
Well, we got some negative Fed speak, or at least it was interpreted that way. You can see the Dow, S&P 500, and the Nasdaq each down by over 1%. Let me just pull up a chart of the S&P 500. We got some comments out of Bullard around noon, and we saw some small fireworks right there. The net result, we went to the downside. Both he and John Williams of the New York Fed saying the Fed is expected to keep rates higher for longer. Williams saying that he doesn't expect the Fed to cut rates until 2024, more than a year and a month away. And I just want to take a quick check of the bond market here. The 10-year T-note yield not doing too much, but here's the U.S. dollar index. Let's focus on that real quick. That is bouncing off of its 200-day moving average, not shown here, but that is a huge movement for the dollar. S&P 500, meanwhile, selling off from its 200-day moving average. All of this put together, do these moves have legs? Well, we got that Santa Claus rally that investors are expecting, at least hoping for into the end of the year. And let's check in on our sectors for today. Everything in the red, as you can see, but taking the biggest hit to the downside, real estate, interest rate sensitive sector, along with energy, materials, and tech. We're going to be talking a lot about crude oil. That is sinking to the lowest levels of the year. And also taking a quick check of the Nasdaq 100. We do see some spots of green, mainly in retail and also Chinese stocks. So again, we're going to be checking up on those, Dave. And I know you're taking a close look at retail stocks as well.
Yeah, two really big stories today. We'll get to China in a moment, but let's get you up to speed first on Cyber Monday and the retail numbers coming in. Online sales expected to hit $11.2 billion today. That's up from $10.7 billion last year, according to Adobe. And that comes on the heels of a record-breaking Black Friday, which topped the $9 billion mark, up 2.3% from a year ago. One surprise from those numbers, well, there's many surprises, just going to highlight one. Walmart eclipsing Amazon among shoppers searching online for Black Friday deals. Let's check on how the Shopapalooza is moving the markets today. Stocks from Amazon up, Walmart in the green, Target up, Kohl's the notable down retail stock among the five, and Best Buy up a bit. So a nice day for the retail sector. Now to our other top story, headwinds for the markets here, and rare protests erupting in several cities across China over the weekend and continuing today, pushing back against the government's zero COVID policy. Protesters also angry over the handling of a deadly fire that killed 10 people last week. There is speculation some may have been trapped in their apartments as a result of these COVID lockdowns. Joining us now is Neil Thomas, Eurasia Group's senior analyst for China and Northeast Asia. Good to see you, sir. So just your reaction, broadly speaking, to these protests and how they compare to, say, 2019 with Hong Kong and Tiananmen Square.
These protests are the most significant we've seen during Xi Jinping's time as China's leader, going back to late 2012. But at the same time, that's coming from a very low base. The hallmark of Xi's reign has been a crackdown on political opposition and a focusing of the party's ability to ideologically control. And I think we need to kind of resist the urge to kind of hope that this is, a Hong Kong 2019 protest situation or a Tiananmen Square 1989 situation, and not underestimate the ability of the Chinese Communist Party to repress and control and to use the propaganda and censorship tools that it has been honing for decades now to bring these outbreaks under control.
And Neil, given what you just said, they've been honing these tools for decades. How much room do they have to crack down even further before there is an even bigger protest and pushback from the existing status quo?
It's a great question. We're already seeing a lot of the protest sites over the weekend be filled with police people, plainclothes policemen, be filled with barricades. People walking around those areas are having their mobile phones checked, and Twitter and other foreign apps are being deleted if they're found. People's information is being taken if they've got photos from the protests. So we're already seeing that repressive response kick in. And I think, the protests on Monday were much, much smaller than on the weekend. And we'll see what happens in the next week. I think the protests, the most likely situation is that the beginning of state controls will see them fizzle out. But if there is a moment of repression, if someone gets injured or even badly hurt, then we could see a revival of the momentum. And especially if we don't see any changes in the zero COVID policy, we think there will be some continued gradual loosening, perhaps slightly accelerated because of the protests over the weekend. But if there's a snap back to even harsher controls, that may also bring people back out onto the street again. But then again, that will likely be met with more repression from the government.
Yeah, again, these mainly focused on the zero COVID policy, but we've certainly seen some reporting where there were demands for Xi to step down. How do you expect him to handle or crack down on these protests should they continue throughout the week?
That's a key watch point. I think if the protests do become more focused on Xi's leadership or on the party's role in China's governance, then that's going to trigger an even quicker and even harsher crackdown. If they remain just about zero COVID, which the vast majority have been so far, there's a bit more leeway, and there is a lot more, shared frustration at that. But we've even seen in some of the reports about the protests that some protesters are urging their fellow protesters not to make these demonstrations political and not to criticize the central government, so they can keep the focus on trying to change the zero COVID policy. So it's a key watch point at the moment. It looks like it's not turning into a bigger national political movement. But if it does, I think we'll see a much kind of stronger showdown between protesters and the security forces.
And Neil, we've seen the People's Bank of China, the PBOC, introduce some relative easing measures over the last few weeks. So we know they're listening, but at the end of the day, where does President Xi fall on the scales of keeping the economy afloat and also reining in these protests?
For Xi, political stability is really the bottom line. So he will do whatever it takes to ensure that the protests don't get out of control. A few scattered vigils of a few dozen people, maybe even hundreds in a couple of cities, that's a manageable problem. But if we do see any momentum to take these protests, that continue this protest and they keep growing, then we will see, I think, a stronger response no matter what the economic consequences. But at the same time, they're trying to loosen some of the COVID restrictions and trying to reduce its economic impact. But it is so closely identified, this policy, with Xi's leadership, that it's really hard politically for him to try and back out of it all of a sudden. So I still think it's going to be many months before we get to a stage where there isn't really a zero COVID policy. And that would be at the earliest reckoning.
And Neil, whether or not the data that China provides actually reflects the damage truly done to their economy, how much has COVID actually facilitated or accelerated the surveillance state by the Communist Party prior to COVID?
Well, everyone now has an app on their phone that shows their status, whether they're allowed into public settings or not, depending on their COVID diagnosis. So, it has certainly increased the surveillance for the Chinese population. But I think it's important to also see the context before COVID. And I think that baseline of censorship, of monitoring, of control, that's the more significant thing than the change that's happened over COVID. We've even seen some pushback against efforts by a few local governments to try and use the COVID apps to stop dissidents from moving around and to kind of crack down on social protests. And those local governments actually backed down and stopped using that data because the national pushback was so high. There is quite a concern about digital privacy in China. On the books, at least, China has some of the best digital privacy laws in the world. But when it comes to the overall kind of equation, we have seen an increase in surveillance over COVID, but perhaps not to the level of the panopticon that perhaps some have feared.
Yeah, on the books, key line there.
Yeah.
Thank you for those insights.
No, that's important to remember.
You bet. Eurasia Group Senior Analyst Neil Thomas. Thank you again. All right, we're just getting started here on Yahoo Finance Live. Coming up, Disney CEO Bob Iger tells Disney employees something he won't be doing during his first town hall since returning to the company. Crowds are following the deals as the holiday season gets into full swing, and airlines screen the most air travelers on Sunday since the start of the pandemic. Don't go anywhere.
When will the Federal Reserve take their foot off the gas? We won't officially know that until Jerome Powell's next move, until his next news conference. That's 2 weeks from Wednesday, but we are getting hints this week from Fed officials and Powell himself when he speaks at the Brookings Institute on Wednesday. Jen Schomburger has the latest Fed speak for us and what it means. Hi there, Jen. What do we hear?
Good afternoon, Dave. Well, before we hear from the Fed chair later this week, we did hear from New York Fed President John Williams, who says there is still work to do when it comes to raising rates, and that he sees a, quote, somewhat higher path for rate hikes than previously projected in September. Speaking with reporters following a speech at the Economic Club of New York, Williams also said he expects the central bank will hold rates at a peak level through at least next year. So until 2024. Now, the Fed official said he sees signs inflation is starting to come down, but he says it will take time to bring underlying inflation down. He's projecting inflation will slow from its current rate of between 5 to 5.5% at the end of the year to 3 to 3.5% next year, though, of course, that's still above the Fed's 2% target. And while Williams' baseline scenario is that the economy will grow below trend and avoid recession, he says the risk of a negative shock occurring and causing the economy to tip into recession is, quote, mathematically greater, especially given uncertainty about the global economic outlook. Now, echoing Williams' sentiment, there's still work to do. This morning, we heard from St. Louis Fed President James Bullard, who told MarketWatch the Fed still has a ways to go and that financial markets are underestimating the chances policymakers will need to be more aggressive next year in raising rates to combat inflation. Bullard reiterated that the Fed needs to raise rates to a range of at least 5 to 5.25. Now, the benchmark policy interest rate now rests between 3.75 to 4%. Investors widely expect the Fed to raise rates by 50 basis points at the December meeting. That would be a bit of a slowdown from the 75 basis point pace we've seen for the last 4 meetings. Dave?
All right, I'll take this, and we definitely saw some stock movement on that. Thank you for that report, Jen Schonberger. All right, stocks losing ground this afternoon. Keith Fitzgerald, Group Principal. Keith Fitzgerald joins us now for more on the markets. And let me just ask you a question here. We were talking with Eurasia Group about the China situation. No big surprise that they believe that President Xi puts his own power above that of the economy there. But I'm wondering, you've done a lot of business in China. What do you think this means for Apple and Tesla, who really rely on the country for a big part of their business and manufacturing, and vice versa? China depends on them for a big part of the business in their country.
Well, I think that's a very sophisticated question with a lot to unpack. The first part of which we've got to understand is that China does not care about cratering its economy. The West perceives these protests as an issue of freedom and exercise that right. China perceives it as a challenge to its authority. So Beijing will not hesitate to clamp down. To your earlier guest point, if these protests accelerate, you can expect a brutal and definitive response from China because they will not tolerate, especially on Xi's watch. As for the companies themselves, they're going to get through this. Apple's already moving outside. I think Tesla is ironically the one that I think is going to have a bigger challenge because it sells a lot into China, even on a more integrated basis than Apple is, I submit.
But quickly, Keith, on Apple, do you think they make any further changes to their production, to the supply chain? Because, look, they are overly reliant on China, and they're very subtle changes they've made in moving to Taiwan and India. Do you think they'll accelerate that?
I do think they're going to accelerate. This is one of the rare miscues, I think, on Apple for the last couple of years. I think they should have been farther ahead of this than they are, but I see them talking with Tata, for example, in India, to talk about iPhone production. They're going to take 25% of global production, get them outside of China's sourced factories and components. We're going to see reemergence into Vietnam, India. I've heard Thailand. I've heard Mexico, even manufacturing returning in some capacity back to the United States. But they can absolutely speed that up if they have to.
And Keith, I want to turn to the U.S. here, and investors really looking forward potentially to some end-of-the-year tailwinds. We got the Santa Claus rally potentially at the end of the year. Wondering if you're on board with this, what you're seeing in terms of any stock strength, notwithstanding what we're seeing today, and who do you like in these names?
Well, statistically, that is absolutely what happens. We get a Santa Claus rally, but the phenomenon is relatively well understood. It's 75% probability or so since 1945. But there are a lot of crosswinds right now. I think the biggest driver is, ironically, the most human element, the one that can't be factored into it monetarily: hope. People have simply had it with being cooped up. They've had it with all the negative headlines. They're getting out. They're spending money. They want to go see their families. So I think all of that powers, or could power, the markets higher much faster and farther than anybody's prepared to accept or think about today. As far as what I like, I think it's going to be key tech because that's where the money's going to go. Cyber defense is a big one. Healthcare is another one. Those are areas that we have to have in our lives. We cannot live without.
Not a lot of hope in the numbers we're seeing right now, Keith. The Dow down 1.3%, the S&P and the Nasdaq both down about 1.5%. Do you suspect that that's the action out of China or something else?
I do. I think that's almost entirely out of China. This is global traders who thought they had one thing on Friday when they left for the evening, and they have another on their hands when they wake up this morning. So it's uncertainty that foments doubt. Doubt creates a risk off or a tap the brakes moment. That's what's happening today. The clarity on the Fed's 2 weeks away. So it's really going to be headline to headline. It's a stock picker's market right now, not an area where you want to be cavalier or just throw caution to the wind.
And we just got a report from Jen Schonberger a few minutes ago on some of the Fed speak today. Not any big surprises. Two rather hawkish statements from Bullard and also St. Louis Fred. Also Williams out of New York, basically saying they're not going to cut rates next year. That would be the Fed waiting until 2024. Wondering what your view is in light of the fact that we have another meeting in just a couple weeks.
Well, my view is they ought to take away the microphones from everybody except Chairman Powell, because the Fed, we've got to be honest, right? The Fed got transitory wrong. They're still getting this wrong. They do not understand the impact they're having on the real world. I think they're great with their models and their inflation, and they've got to change the definition of recession. I get that. But I think to create doubt right now is not what the markets need. It's not healthy for the country. They've got a fiscal problem in that the government keeps spending money. So it's not necessarily the rates like they're trying to stick to their talking points with.
All right, quickly, there's a few names that you think might not get through this next couple of years. Who are they?
Well, they're going to be stocks that are on the margin. They may be things like Zoom or Peloton or Carvana. These are stocks that were once upon a time Wall Street darlings, but always the hot money. The question that people need to be asking themselves right now, and we talk about with our folks all the time, is you want to stick to the very best names you can buy, companies you know that are going to be there in 5 years, 10 years when you need that money, because very realistically, a stock like Carvana or Peloton might not be at this point. The markets have moved beyond the fascination with those stocks.
Yeah, Carvana feels like they might not make it through the year. Fitzgerald Group
Exactly.
Principal Keith Fitzgerald. Great to see you, sir. Appreciate that.
Thank you.
All right, Bob Iger holding his first town hall today with Disney employees since being reinstated as CEO over a week ago. Iger posting this tweet, writing he's, quote, filled with gratitude and excitement to be back at Disney. Yahoo Finance's Ali Canal joins us with the details of the town hall. He gets his performance, Ali. He started with quoting Hamilton. What did I miss? Quite a bit.
Yes. I mean, this is a guy that was at Disney for 4 decades, CEO for 15 years. He's a beloved figure, especially when it comes to the Disney workers. I did have a chance to speak with one Disney employee who told me that he's really optimistic for the future, that he's really glad Bob Iger is back in the CEO seat. But probably the most important element, the most important piece that we got from this town hall was Iger holding firm on those hiring freezes that we saw from Bob Chapek earlier this month. He says that those will not be halted. I think that means potential layoffs are probably on the table as well. And I think this all has to do with Disney's quest for profitability. And Iger did say that streaming profitability is very important. The company will no longer chase subscribers since Wall Street no longer cares about those. So that's something to watch. And I think we're going to continue to see Iger really flesh out his business strategy moving forward. Another thing that Iger will not do is M&A, at least right now. He said he's pretty content with Disney's current asset class. And a lot of analysts had been curious about this since Iger had been so instrumental when it comes to leading some of the top M&A deals for Disney over his tenure previously. But he said that's not going to happen. He also shut down reports that Apple is buying Disney. Media World was having a field day with that. He said, no,
Why wouldn't they?
That's just rumors, just speculation. And then finally, another point I want to call out has to do with the theme park business. He said that he'll re-examine the theme park reservation system. And this is an area that Iger will have to reassess. Chapek, he came into the CEO role as the theme park guy. And through his leadership, we did see the theme park consistently outperform. However, now with this macroeconomic backdrop, the fact that he raised prices across the board, that didn't sit well with a lot of fans. And according to the Wall Street Journal, Iger was shocked at how quickly those prices went up over Chapek's tenure. So that's going to be something to watch as well. So we got little bits and pieces. I still think there's more to come from Iger and his restart, I guess I should say, here at Disney. Yeah. But for now, that's what we got.
Well, one quick follow-up on the subscribers. One note, he said he wants to chase profitability from streaming rather than new subscribers. So not fixating on the bottom line number or the top line number, however you want to say it, but profitability, meaning cost cuts?
Yeah, and I think that's what we're seeing with the fact that he's holding those hiring freezes. We heard from Bob Chapek before he was ousted that was something that the company was aggressively going to target. So I think cost cutting is a real driver here that will continue to be a focus for Disney. And the theme parks have also really powered a lot of DTC. So at what point do you look at your theme park business and really consider whether that should continue to be the driving force, especially with all this uncertainty?
Leads me to believe maybe they will not be bidding on the NBA deal. That's going to be in the neighborhood of $70 billion a year, and you can't cost cut your way to grabbing the NBA.
Right.
Interesting. Good stuff. Ali Canal, thank you so much. All right, the holiday shopping season in full swing and already setting records. Up next, we'll take a closer look at the winners and losers.
Welcome back. Let's get a check on some of the retail stocks on the move. The big winner today, Shopify. Company saying its merchants saw sales jump 17% from a year ago. Top categories include apparel, accessories, followed by health, beauty, and home garden.
And if the estimates are accurate, you're probably watching this while shopping online simultaneously. We appreciate it nonetheless. Cyber Monday sales projected to eclipse $11 billion today after a record $9.12 billion was spent on Black Friday. Let's discuss it all with Argus retail analyst Chris Gray. Chris, nice to see you. The numbers sound huge, except when you think about how much that is due to inflation. What's your read?
Yeah, I mean, some of it is definitely due to inflation. And the place we probably see it the most in my forecast is in grocery stores. Normally grocery is 1, 2, maybe 3% grower. And my forecast for the holiday season is 7-ish. So that's a big part of that. And when I cover the consumer products companies, and some of them are raising prices in the neighborhood of in the low double digits. So, inflation is definitely a big part of it. And we're comparing with last year as well, where retailers didn't have very many markdowns because there were supply chain shortages.
Hey, Chris, we're getting some of the online holiday numbers in addition to the physical stores. And of course, today is Cyber Monday. Maybe you could just go through some of where we stand in terms of the relevance of this year's stats versus prior years and how they fall in line with the march into the last week of the year here.
Yeah, it's a really good question. And number one, I would say put any of the numbers we see into perspective. Some of the numbers, I think you cited before from Adobe, are up kind of 2-3% for Thanksgiving and Black Friday. MasterCard, put Black Friday sales overall up at plus 12 in store, plus 14% online. In my forecast for holiday sales, overall holiday sales, which is plus 5 for the season, I've got e-commerce as plus 5 for the season. And that's probably the hardest call I have to make because, we're lapping such strong growth over the last couple years, both in overall retail sales, where we're coming off, 2 of the biggest growth years in the last 20, and, non-store sales, which is what the category is called, up really strong in the last couple of years, both coming out of the pandemic and following on next year. So the question is, how much share does online continue to gain? And one of your guests spoke earlier, and how much does online lose, or is the growth muted by the fact that people just want to get out and shop and kind of return to the excitement of being in stores?
Although it looks like most of the shots and coverage we saw from malls was muted at best. One of the alarming economic trends coming in was consumer savings down and consumer debt skyrocketing. Buy now, pay later seemed to be a trend that really popped up on Black Friday. What was the shift like there?
I think the one thing that kind of stuck out to me as I visited stores that was kind of, a little bit disappointing, and it syncs with the point you've just made. I think Walmart calls it Action Alley. The way I went into the store, the first things you saw were, rice and beans and cans of spaghetti and meatballs, flour, cooking oil, all things that were really, put there to help people make ends meet in a very tough time. I mean, these weren't frilly and, highly discretionary items that people who shop at Walmart, basically everybody, would be buying when they were flush with cash. So, I mean, that's kind of the lower side of the bifurcation that we're definitely seeing in the economy.
And getting back to the inflation question here, we've seen, it seems to be making it difficult for comps. In other words, if we got headline inflation at 7% and sales are running at 5% year over year, in addition, so it's I guess you would say it's a 5% spread from last year, but it's still running under the inflation rate. Is that actually a beat? That's a question that I'm hearing. And then I see in your notes, you're further expanding the universe of sales here. You're grouping them by grocery stores, general merchandise, e-commerce. Is that simply because it's difficult to make these comps given the inflation backdrop?
So yeah, I'll try to get both your questions. I mean, the thing that's so hard is that the traditional trends have changed since the pandemic. And then the first big thing was, the first year of the pandemic, the way I calculate it the same way the National Retail Federation does. So it excludes auto dealers, it excludes gas stations, it excludes restaurants. So that first year of the pandemic, nobody was going to restaurants and all that money went into grocery stores. This year, the thing that's weird, as we talked about before, is we have all of the growth in grocery stores, normally a low single digit category, probably growing 7%. General merchandise, I've got at 4, e-commerce at +5. And the reason I call those three out is they're the three biggest, within the universe, and they're the three that have the biggest impact on the move. E-commerce has a very big delta. And to your other point, in terms of the comp sales, the one place where we see it very clearly is in some of the consumer products companies, where they'll actually call out, they'll call out their organic sales, and then they'll call out volume, and then they'll call out pricing. And in some of the cases, this is a hypothetical. I mean, you'll see a 10% increase in sales, and it's +12 in pricing and down 2 in volume. And then, within the retailers, you'll see it broken out by traffic and ticket, and some of them will even go further, and they'll break out, the average unit retail, they'll make out price, and then they'll break out units per transaction. So not all of them, dive that deeply, but your point is a good one, that a lot of the growth we may be seeing, may be coming simply from higher prices. That's a factor in inventories as well.
The age-old distinction between nominal and real. So thank you for that analysis, Chris Grea. Thank you. A major milestone for the airline industry. 2.56 million passengers were screened by the TSA yesterday, the highest number since December of 2019. However, it was still below post-Thanksgiving travel in 2019, which saw 2.87 million passengers screened on the Sunday after Thanksgiving. And despite concerns heading into the weekend, delays and cancellations were low, with FlightAware tracking 179 cancellations into and out of the U.S. on Sunday. And Dave, if you miss a flight, you miss a flight. You probably don't care about what everybody else is doing, but that number seems pretty low. Just wondering what you were doing over the weekends, if you were out shopping, saw anybody traveling, or
I traveled, yes. Yeah. I traveled on Thanksgiving and back yesterday, and I will tell you the demand is through the roof, and the difference between now and 2019 is prices are up dramatically. So the question is this still revenge travel, or is it really just a new norm, Jared? And I think it's a new norm. I don't think it is still revenge travel. I think people have just, as you're seeing with remote work, people would rather value being at home. Now they'd rather spend their money on travel, on experience, on doing things, rather than on goods. I think we've just got a permanent shift in how people spend. And if you had a flight canceled and you were on Frontier, you're probably angry this morning because they have done away with their customer service telephone line entirely. It's all got to happen digitally now.
Not a good look there.
Yikes.
Whoa, coming up, chaos surrounding Taylor Swift concert tickets. Isn't Live Nation today? See who's bullish on the live events platform after the break.
All right, time now for Triple Play. 3 stocks we're watching in the final 30 minutes of trading. Today we've got Live Nation, Pinduoduo, and DraftKings. Josh Schaefer joining us today. My play is Live Nation Entertainment. Despite being under fire for the debacle surrounding Taylor Swift ticket sales, shares are up today after Citi upgraded the stock from neutral to buy and suggested there's an 80% chance the company will not be forced to split up Live Nation and Ticketmaster. Now, just last week, U.S. senators with antitrust oversight announced they'll soon hold a hearing looking into competition in the live ticketing industry. Senator Amy Klobuchar writing that Ticketmaster continues to abuse its market positions. Even ahead of that, the DOJ had announced a probe into Ticketmaster. However, it was Citi analyst Jason Bazinet who said there's a 20% chance they are broken up. Bazinet did, though, lower his price target to $82. Still, though, that implies a 30% upside. Now, Live Nation was up more than 2.5% when I picked this stock. It has since come back down to earth and is almost flat at the moment. So there goes my narrative, but still down more than 40% year to date. Point is, he doesn't think there's much of a chance of breaking these two up, Jared.
I don't think so. Protests from the people in my life who love Taylor Swift. I don't get enough of this. Just, $1,000, $2,000 for tickets in a different city.
It was a nightmare. It was a disaster. They are going to have to go to Capitol Hill. I assure you that.
All right, my play is Pinduoduo, which shot up to a one-year high almost to the day after nearly quadrupling its 2021 third quarter profits per ADR and besting the street's estimates by 80%. Citi, which rates the Chinese e-commerce play a buy with a price target of $79, they're saying that it is results, they mark the second quarter of blowout results where despite a difficult COVID macro environment, quote, revenue and earnings grew more than expected, also highlighting that, quote, the massive profit beat once again demonstrates its high operating leverage of the marketplace model. And just looking at a multi-year chart here on the Wi-Fi Interactive, we can still see it's mired in the bottom end of its range. But this stock has really shot up over the last month. And let me just show you a 2-month chart here. There we go. Boom. Up about 17.5%.
And Jared, that's a stock too the street loves. I was taking a look earlier. 50 buy ratings, 3 hold ratings, 0 sells. Not very often you see that much of a consensus on a stock. Not that much upside that they see though, about 20%, but I was still impressed by that.
Yeah, a lot of those analysts, Chinese analysts, so take that with a grain of salt as well.
Yes.
Well, my play today is DraftKings. Shares down about 5% today on a downgrade from JP Morgan analyst Joe Greff, and he's highlighting that DraftKings recently issued 2023 guidance of a $470 million to $570 million EBITDA loss in 2023. That came in worse than expected than what JP Morgan had. They had that number about $100 million lower, guys. You add in that the stock is up 20% since earnings, big drop on the day of earnings, then up 20% since, and Greff is pretty much saying the stock's just valued too high right now. They have a $12 price target. He's not really sure why these shares have gone back up. And then, Dave, the other thing to watch here, too, is always talking about profitability with DraftKings, right?
That's it.
And Caesars posted digital profitability in October, they said. You have MGM projecting profitability sometime next year, FanDuel projecting full year profitability next year, and DraftKings saying they're going to lose somewhere in the neighborhood of $500 million. So if you're going to own one of those stocks, he's pretty much arguing DraftKings just isn't the one to own next year over the next 12 months. Seems like probably a fair take there.
It does. BetMGM. MGM was down today about 2.5%. Caesars was down about 2.5%. It'll be interesting. Fanatics is getting in this game, a company valued at $27 billion, private company, getting in this game early next year. Will that further impact DraftKings upside? And they didn't get California. That was another big miss. Josh Schaefer, thanks for playing today. Coming up, it's been a roller coaster ride for the oil market today. What's driving the action and what it means for the price at the pump. Next.
Welcome back. The COVID protests in China are not only weighing on stocks, they're also impacting commodities as well. Oil sliding to $74 a barrel earlier, hitting its lowest point in nearly a year, but prices climbing off this low after the afternoon of report that OPEC Plus will seriously consider new production cuts after its meeting on December 4th. Joining us now is Andrew Lippo, Lippo Oil Associates President. And Andrew, great to see you here. Let me ask you, what do you expect out of OPEC Plus next week? Any chance of a change in their policy? We got some rumors a couple weeks ago to one end, and now they might be flipping. Where do we stand?
Well, I originally thought at the upcoming meeting they'll actually keep the status quo, as we saw oil prices had been stabilizing around $80 a barrel. But now with these additional lockdowns in China and the spread of the COVID virus throughout their country, people are concerned about demand. In fact, people are forecasting to revise downward China's demand for oil by over 500,000 barrels a day this year. And as a result, we've seen OPEC Plus, especially Saudi Arabia, take a proactive stance in trying to support the oil prices, given its recent production cut of 2 million barrels a day last month. So I think it's in the cards that we could see another production cut coming up next week. But in addition, we do have the Russian sanctions that are supposed to be going into effect by the European Union on December 5th. So they may actually take a wait-and-see attitude until their January meeting.
And of course, you have the G7 price cap on Russian oil. What do you expect the impact to be of that change? And that's, I think, a week from today.
Well, that's exactly right. It's on the same day as the European Union ban goes into effect. And what we're hearing is talk of a price cap of around $65 to $70 a barrel. But that price cap is higher than the current sales price of Urals crude into Europe or into Asia of around $60 to $64 a barrel. So the market is actually not anticipating that much of an impact. In addition, we've seen the sale of numerous older tankers that we describe as going into the shadow fleet that would be willing to lift Russian oil and deliver it to China and India and elsewhere to circumvent the European Union sanctions.
I want to ask you about Venezuela. As I hinted before in the open, Biden administration giving the green light to Chevron to pump some more crude out of there. But Venezuela has some of the largest reserves in the world. There's a lot that could be done there. What incremental change is this going to have, if any?
Well, given the decrepit nature of the Venezuelan infrastructure, we shouldn't expect any significant change for a number of years. But I do think that Chevron, through its own production, could add 80 to 100,000 barrels a day of production over the next couple of months. And that production is going to go to refineries on the Gulf Coast.
So we've just talked about numerous geopolitical events. How will all that impact prices at the pump here in the U.S. and as well as diesel prices?
Well, there is some good news for the consumer, especially when we saw crude oil prices hit nearly a one-year low this morning. I expect that the current national average of $3.55 a gallon for gasoline will decline another 10 cents a gallon over the next week. And by Christmas, we actually could see gasoline prices be lower than last year's Christmas price of $3.29 a gallon.
All right, we're going to have to leave it there. But thank you for that, Andrew Lippo. Coming up, new fallout from FTX's collapse. Find out the latest crypto platform to file for bankruptcy. Up next.
fallout from the collapse of crypto exchange FTX widens as crypto lender BlockFi is filing for Chapter 11 bankruptcy protection in New Jersey. Yahoo Finance crypto reporter David Hollerith joins us now. David, good to see you. That question has been, since FTX went down, everyone looking around, who's next? And now we know.
Yeah, just a little bit about BlockFi's history over the past year. As many know, they faced troubles over the summer, along with competitors, Voyager Digital and Celsius Network. And unlike those two, which filed for bankruptcy in July, BlockFi was saved by a white knight bailout from FTX. And obviously, in recent days, many people have seen how the bailout has turned out to be its undoing. So this is not necessarily a surprise. BlockFi paused withdrawals almost 2 weeks back, and when that happens to a crypto company, it's typically difficult to revert in terms of avoiding bankruptcy. So the company has more than 100,000 creditors in its bankruptcy petition, and about anywhere between $1 and $10 billion in assets and liabilities. It was also revealed, too, that its three biggest creditors are Ancura Trust, which is a distressed loan administration company, West Realm Shires, which is an FTX affiliate firm, and also a settlement payment it made to the SEC, which is still outstanding. And according to its declaration, which was also filed today, the results what sort of happened that led to the bankruptcy and BlockFi filing for Chapter 11 ultimately was a liquidity shortage, which started in the first 2 weeks of November, wherein BlockFi requested more credit from FTX, and an FTX affiliate firm, Alameda, eventually defaulted on $680 million in loan obligations. Now, going to this restructuring, BlockFi, has about $256 million in cash to pay for operations. It's also laid off about 2/3 of its workforce to cut expenses in bankruptcy.
And yeah, I find it pretty interesting that the SEC is listed among the creditors of BlockFi. But let me ask you, everybody's wondering who's next. Is it one of the big remaining firms at the top? Who's at risk for bankruptcy here next?
Yeah, it's not a secret that Genesis Lending was a larger crypto lender than BlockFi, has also paused withdrawals about 2 weeks ago. We're waiting to hear what the latest word is from them, and they're the one to watch. So since pausing withdrawals, they've said that they're seeking anywhere between $500 million and $1 billion in additional investor funds. And for perspective, I think BlockFi originates about $2 billion in loans, and Genesis has originated about $2.8 billion, and that's as of the end of the third quarter. So this is a bigger firm, and they have a lot more outstanding clients who obviously could mean a lot more contagion for smaller firms.
All right, David Hollerith, good stuff there. Thank you, my friend. Coming up, we're counting down to the closing bell on Wall Street. All three major indices down more than 1.5%. We'll see how they close. Coming up on Yahoo Finance Live.
We are only minutes from the closing bell, so let's break down the market action. We see the Dow, S&P 500, and the Nasdaq each off about 1.5%. Just quick look at the intraday price action. Did have some fireworks from some comments, rather hawkish comments from both Bullard and someone else from the Fed. But let's get to the price action, the heat map price action for today. And in our sectors, we can see everything in the red. Staples leading the pack, but the least dirty shirt in the laundry basket. Real estate taking it on the chin, down 2 3/4%, followed by energy, materials, and tech, all of those down more than 2%. And if we take a look inside the Nasdaq, we're going to see some weakness, kind of a mixed board among the mega caps, Amazon, as well as some other electronic retailers enjoying a little Cyber Monday love here. That's up about 2/3%. With less than a minute left, looking like we do have some action in Chinese stocks. So let's take a look at that. I was talking about Pinduoduo earlier on, but despite some of the chaos in China, guess what? You might not expect to see all this green on this particular board. Here are some ARC components. Disruption not faring as well. You can see Tesla, the big one, that's about break even. Zoom down 5%, Coinbase down about 3.5%. And just looking inside the tech sector, we want to take a look at semiconductors. A lot of weakness here. Micron down 4%, Qualcomm down 3%. And in the software, we also see a little bit of weakness as well. Here's your closing bell on Monday.
All right, there's your closing bell on Wall Street. Let's see how the markets close to start this week. Not so good. As you can see, all three major indices down about 1.5%, led by the Nasdaq continuing to fall 1.58%, just about 177 points. Let's talk about it. What happened today? Bring in Kathy Entwistle, Morgan Stanley Managing Director, and Quincy Crosby, LPL Financial Chief Equity Strategist. Great to see you both. This always feels like Monday after Thanksgiving. You know, you ate too much, you drank too much, you got to go back to work, but that's not driving the markets. What is, Quincy?
Well, you know, we had a strong run in the market. We were able to just cross over 4,000 on the S&P 500. And then, you know, you could argue that the market was overbought coming into today and that you would see some profit taking. We didn't expect this much. I think China and the events there, you know, served as a catalyst for even, you know, more profit taking and concern.
Hey, Kathy, let me throw this to you. The day's price action governed by China coming into the market, also some hawkish statements by a couple of Fed members. What are you seeing, and does this add to the narrative? How does this add to the narrative that we're seeing evolve into the end of the month?
Yes, thanks for having me. And at Morgan Stanley, we've had this fire and ice narrative that we've been following. And the fire piece has to do with the Fed raising interest rates and how that affects the markets. We think that that's baked into the markets at this point, and that's done. What we're seeing now, or what we're going to see eventually, is that the ICE piece will come through, and that is companies having to revise earnings, their forward earnings forecast. And that will bring, you know, the PEs are too high still. The price of the stocks are too high, and they've got to come down a little bit more. And once they start showing their earnings are not going to be what we're expecting, that will bring it down.
All right, Quincy, let's get your reaction to fire first. Being Fed speak, anything surprise you today? Is your expectation of 50, 225s and a pause? And if I can just double you up there on the ICE side, do you expect further downgrades to Q4 earnings?
Well, yeah, we do. And, you know, the question has been, has the market fully discounted a recession, albeit at LPL we see a, you know, milder recession with all of the information we have at this point? And the answer is probably not. And I think absolutely when the earnings start to come in, when we start to see pressure on you know, margins, you're going to have a market that is seen as just being too expensive. Right now, or early this morning before the market pulled back even more, we were at 17.5 times forward earnings. That's pretty expensive for a market that is going to face a slowdown, most likely a recession, and a Fed that probably has to add about another 100 basis points before they're finished.
Kathy, what do you like here in terms of investments? Because investors may be crossing their fingers for a Santa Claus rally. Hope is not a strategy, though. What are you recommending to clients?
We're recommending to take advantage of these times when the market is having like a bull rally during this bear market to reallocate the portfolio, to clean up some of the holdings that you don't want in your portfolio anymore and reposition them into things that we like. Surprisingly, right now, cash is king. It's very powerful. You're getting paid for your cash. We also like bonds, municipal bonds, corporate grades, and also high grade corporates, I should say, and also treasuries. So the equity portion is a little tough right now. We're being very cautious and careful and just legging in when we have more downdrafts in the market versus up in the market.
Quincy, do you have a similar strategy? And what sectors are you a believer in the quarter ahead?
Well, yeah, I mean, we also, advocate the treasuries, investment grade, short duration, very attractive for investors, and cash. I mean, I'm looking at CD rates. They're very attractive. But on the equity side, we still like healthcare. You've got the biotech component, which is more of a risk-on component of healthcare, but you're being offered dividends. And I think that once capital markets come back to life, you're going to see quite a number of deals in the healthcare space, biotech, and larger pharma. So that's attractive. I want to also say, I know oil prices have come down. We actually like energy, the energy complex, I should say. That includes natural gas. It includes the service companies. It includes exploration and production, and also integrated. Now, everyone thinks you need to make about $100 a barrel in order to break even. In the U.S., the big integrated names need about $40, $45 to break even. But we do think that this pullback has been exacerbated by the concerns over China. Do they reopen? They're the largest importer of oil. And also we had a major expiration, options expiration just around Thanksgiving time, which created more volatility in the market. There's less liquidity in the market. We think that is going to change. One thing that has not changed is that the structural aspects of oil, there's a shortage. We have a shortage, and we need to get to the green side if that's where we're headed. But we need to be going. America needs to run on something, diesel and fuel, till we get to the other side.
Hey, Kathy, we got a minute left here. Your thoughts on the strong dollar, because it's bouncing off the 200-day moving average for those in the technical camp. What does a strong dollar mean to you?
The dollar has always been the safety, the place of safety. And I think there's so much disruption right now going on around the world between the war with Ukraine and Russia. Now we've got China with COVID and some issues there. We've had the supply chain going on. So it's just basically been where people go for a safe haven. And to just add to what was said earlier, from the equity standpoint, we do still think that investing in the U.S. and investing in areas like healthcare, energy, defensive stocks, and also dividend-paying stocks is the way to play the equity market.
All right, a little bit of safety there. Thank you to you both, Kathy Entwistle and Quincy Crosby. Coming up, Elon Musk ignites a war of words with Apple, on Twitter, of course. What's the latest, and what does it mean for the overhang on Tesla shares? Up next.
Elon Musk is making more waves after his Twitter takeover, tweeting earlier that Apple has threatened to withhold Twitter from its App Store. Yahoo Finance tech editor Dan Howley is here with the latest. He's just got a bunch of popcorn sitting here and watching Elon tweet. Dan, it is remarkable. Here's the playbook. Let me scare off all the advertisers and then take on the biggest company in the world that literally controls your success or failure. What do you make of all this?
Yeah, it's really an interesting move, right? Because he kind of started this out just as claiming that they are trying to fight them. Basically, the first tweet that he sent on this was that Apple has mostly stopped advertising on Twitter. Then he questioned whether they hate free speech in America. Then he said that they're censoring people, asking who else they're censoring, saying that they have a quote unquote secret 30% tax for app developers or at the App Store. This is all kind of seemingly just show because he wants to turn Twitter into a subscription-based service. And so the 30% fee would be applied to anybody who would be applied to anybody who purchases a subscription through the Twitter iOS app. That's basically how Apple works. And, this fee isn't secret at all. It was kind of the main piece of a lawsuit, an antitrust lawsuit between Epic and Apple over Fortnite. So it's not as though this is some, unheard of fee that companies have to pay. There's also the idea that, Musk is taking on Apple and essentially, threatening that they could take Twitter out of the App Store. Now, it's not unheard of for Apple to do that. They had removed Parler previously before reinstating it because Apple didn't like the lack of moderation on that platform. And, it really is entirely up to Apple what apps are allowed on the service. There's been arguments as to whether that's fair or not, but it is on their terms of service, and companies have to abide by that if they want to appear on the App Store. Apple's response to that usually is, if you don't want to be on the App Store, there's Android. So, I think in the big grand picture here is that Twitter needs Apple far more than Apple needs Twitter. I highly doubt that people, unless they're huge Elon Musk fans, are going to ditch their iPhone and years of photos and conversations just because they can't get access to Twitter. They'll figure out some other way to get to it, perhaps via the web app or something along those lines. But yeah, this is a very interesting fight and one that Elon Musk seems very interested in picking.
Well, and Elon has said before that he might just go and build his own phone. Don't know how realistic that is, but what are his options here? Because it really makes you think he might be grasping at straws, but he's pretty famous for going for these moonshots.
Yeah, he goes after companies like this. According to a report by the Financial Times, he had called up a number of or reached out to a number of advertising companies or companies that slowed their advertising or ceased advertising on Twitter and basically, criticized them for doing so. You got to imagine that's not going to play out well for those advertisers in their future on the platform. But, as far as his chances or what he could do, he could try to lobby against the 30% App Store fee. That's something that a lot of companies have tried to do in the past, and it's being looked at in different jurisdictions around the world. But making a new phone, I don't think that's going to get many people on board.
You got a cat over your shoulder, right, brother? I mean, you are unfazed. There he is. What's his name? Is it Apple or is it Elon?
That's Buddy, and he's chewing on the Christmas lights because he does that every year.
All right. Got to leave it there. Dan Howley and Feline Friend, thank you for that report. Joining us now is Wedbush senior analyst Dan Ives. Dan, thank you for joining us here today. You cover both Apple and Tesla, and we were just talking with Dan Howley about Elon Musk, but I want to focus on Apple here and some of the protests that we saw. We saw the protests at the Foxconn facility last week, and the big question is, what kind of a dent is this making in terms of their ability to service the holiday rush?
It's been a gut punch. I mean, at the worst time possible for Apple. I mean, we're talking shortages in a lot of Apple stores of upwards of 30% of iPhone Pros in terms of, iPhone 14. And, I think this is something they've been able to navigate zero COVID probably better than any company out there in terms of China. Clock finally struck midnight for Apple in terms of they're not able to do that anymore. The Foxconn situation has really been a body blow, and that's really what's starting to play out across the board. We could be looking at 5 million units on the low end, potentially 8 to 9 million unit shortages on the high end.
It's been revealing, Dan, and not just the protests, but we've learned that it's essentially slave labor making iPhones. I mean, maybe that's going too far, but all the reporting I've seen, you're talking about 12-hour shifts rotating, essentially what people are describing as forced labor. Do you expect Apple to make any production changes, begin to move, fast forward things to India and to Vietnam? And how big a dent will this be in their Q4?
Yeah, look, I think the biggest problem is the zero COVID issue, right? I mean, the zero COVID policy in China, I don't think anyone in their wildest nightmares thought we'd be sitting here going into December 2022. And it's actually getting worse in terms of the restrictions. And that's been something that's caught, I think, Foxconn, Apple by surprise, and basically every other company, including domestic. Look, realistically, best case, if they look to move production, 5 to 7% would be the most that they can move out of China by 2024. I mean, that's really cemented in terms of the supply chain. That's why right now, getting an iPhone 14 Pro is nearly impossible before the holidays.
I want to turn our attention back to Elon Musk and Twitter and Tesla, specifically Tesla. Stock coming off of 52-week lows, big decline there. I'm just wondering, when does Elon stop, or when does he have to stop selling his Tesla stock? And is Twitter too much of a distraction for him?
Look, I even thought when Dan Halley was talking about it, even the cat was shocked when he was explaining the situation.
Good point.
Look, I think the biggest frustration here is that Twitter is essentially quicksand. And the concept that Musk is going to have to sell Tesla stock to continue to fund Twitter, that's been a broad overhang on the stock. And I think but the bigger issue is just on an hourly or daily basis, just continuing to have black eye moments for Musk. And just another one today. Let's pick the one company in the world you never want to pick a fight with, Apple. All right, so let's do that. And I think that's part of the problem here is that Musk is, I think from a brand deterioration perspective, it's having an impact, I think, in the public perception on Tesla. And that's been overhang on Tesla stock.
You must be thrilled to see Elon suggesting that if he can't get on the App Store, he might just build his own phone. Does Apple need Twitter? Certainly he needs Apple, but does Apple need Twitter?
I mean, Apple views Twitter like a piece of bread at the restaurant before you get your meal. Now, Twitter needs Apple for basically for everything. So I think part of the problem here is that, okay, I get some of the frustration from an advertising perspective, because I do believe Musk, continues to be very frustrated as advertisers are, we'll call it pausing or at bay, at least until they get a better sense of the platform. But here fundamentally is the biggest problem. The golden child's Tesla. And Musk, at least from a perception perspective, attention is spent more and more on Twitter. And that is really creating what I view as just a PR black eye from Musk and therefore for Tesla.
If we can, let's take Musk out of the Tesla equation for a while, at least on a headline basis. Does Tesla have what it takes to grow sales next year in a meaningful way beyond analyst expectations?
I think that's been the frustration. In other words, the Tesla story fundamentally, I think, is extremely well positioned for 2023. Where we are in the EV inflection, I think we could be looking at 2 million units potentially for next year. They obviously have run into some issues like every other auto player. But if you look at the Twitter overhang and the Musk overhang on Tesla, it's significant because Musk is Tesla, Tesla is Musk. And I think that's why this has really started to get just agonizing, almost exhausting frustration for Tesla bulls, because the irony is the Tesla story is actually doing well.
I want to ask you quickly about Twitter, Dan. If you have to pay for that blue check that you've earned, how much would you be willing to pay per month? And what are the chances you think Elon can build a winner at Twitter based on what you've seen in the first few weeks?
Look, in terms of Twitter, and obviously we covered Twitter as a public company, I mean, it was a bloated structure. It was going to have massive headcount cuts regardless of who owned it. So that was something that was overdue. Now, to the extent that that's happened, that's a little, obviously jaw-dropping. But from a revenue perspective, look, the verification is going to be the first pass. What the adoption rate looks like on blue checks, is that the first sort of step in the right direction? But it's advertisers. I mean, we can talk about subscriptions all we want. You need to increase advertisers, increase engagement, but monetization of Twitter, that is an Everest-like uphill battle, for Musk.
And you cover the EV space in a larger sense. Just wondering, anything stick out to you, anything you want to bring to the forefront here, giving you the floor with the last minute?
I'd say GM. I think what they're doing right now, obviously they've had steps forward, steps back. I think they're set up for a massive year in terms of 2023. I think Ultium, from a battery perspective, the models are going to hit. I think everything that they've sort of laid out in the sort of phase 2 of EVs, I think they could be extremely well positioned, as well as with Ford. I think there's a renaissance in the 313 area code around EVs.
Got to try one last time. How much would you pay monthly for Twitter?
Look, I think it comes down to like $8 is pretty easily digestible, right? From a verification perspective. But the question is, even if you had mass adoption there, we're talking about 4 or 5% of revenues max. It's like that's solving just one piece. But obviously, there's a lot more heavy lifting ahead. But again, you start to lose celebrities, athletes, and others. That's the secret sauce of Twitter. That's why right now Musk, I think is we'll call them high risk plans ahead as we're looking at some of what he's talked about.
Nobody better to have here on this day than Wedbush Managing Director, Senior Equity Analyst Dan Ives. Good to see you, sir. Appreciate that very much.
Thank you.
All right, coming up, Cyber Monday sales set to break records this year. Our next guest tells us which categories will be the biggest winners. Stay tuned. We didn't just stuff ourselves with food over the holiday weekend. We filled our online shopping carts. Consumers expected to spend an astonishing $34.8 billion from Thanksgiving through today, Cyber Monday. And that's up 3% from 2021 and what continues to be a strange recession, doesn't it? Taylor Schneider is the Adobe Senior Director of Digital Insights. Good to see you, Taylor. I have asked this for a number of guests, but is this all inflation? People are making out a huge storyline out of the record sales, but isn't it all inflation?
Well, one of the great things about being at Adobe, this is the time of year we get to look at, a trillion data points across thousands of companies to answer exactly that question. Mm-hmm. And what it comes down to is, honestly, online, the inflation that we're seeing across all of those transactions across 85 of the top 100 companies is actually flat to negative in the online space. So we're not looking at rent, we're not looking at gas, we're looking at what people buy online. So when people go out and they're going to spend $11 billion today, a lot of that's going to be real. That's going to be in a space where inflation and prices aren't going up. If anything, discounts are bringing those prices down.
And what kind of trends are you seeing in terms of what's hot this year? You can give me brands or just entire categories.
Oh, sure. So, I think the thing that we've seen over the course of the season is that computers, toys, electronics, all the things that had supply chain challenges last year are seeing really big discounts this year. Consumers are getting great offers, and consumers are jumping in and taking advantage of those purchases. For me, if you're out there shopping, items like drones, like MacBooks, as you say, in fact, and TV adapters, so you can stream TV. Those things are really big this season. So there's a lot of good offers out there for consumers.
There's a lot of categories that certainly need some wins. I'd never met Bluey, the toy we just showed. Any losers, Taylor, stand out to you?
Well, I think the hardest thing, honestly, in this economy has been the Christmas meal. I said, the online inflation is not big. In fact, it's kind of flat. But where we are seeing rising prices still to this day is in food, milk and eggs, and the kind of meat things that you put on the Christmas dinner table. Those prices are way up from years ago, and that is eating into consumers' wallets.
Yeah, I know from years ago, this is pre-pandemic, the biggest sales days of the year tended to be the weekend right before Christmas. I don't know if the pandemic has changed that, but what are you expecting as we head into that final week of December?
Well, retailers have started this season really early with deep discounts as far back as October. And we've seen really strong deals going into Cyber Monday today. When we look into the future, I expect to see, maybe not the hottest deals. So if you were looking for something that was a truly amazing deal, you might have missed it today. But there's going to be good opportunities for consumers way up into almost Christmas, especially in a world where the logistics companies are able to deliver the goods, and if they're not, there's a lot of buy online, pick up in store, pick up curbside opportunities for consumers who are doing their shopping online this year.
Taylor, to you, what's been the biggest consumer change coming out of the pandemic?
Oh, I think consumers have shifted a huge portion just of their daily lives into the online space. So, Cyber Monday started as a place where you'd buy CDs and books and gifts, but now people are buying their cereal, their clothes, their everyday items on a regular basis in the online space. And so while we still have an online retail economy that is driven by these big days and these big gifting periods, it is now an engine that just runs all year, and it's a huge portion of our retail economy now.
All right, got to leave it there, but appreciate your insights and those of Adobe. Taylor Schreiner, thank you. The end of the year is approaching, and there are a few moves you should consider making to get the most out of the benefits you could receive from tax season. Yahoo Finance's Jana Heron joins us now with the details. Jana.
Hi, thank you for having me. Yeah, so I think one of the big ones for our audience is, given the stock market volatility, is selling some of those investment losers before the year end, and you can use those capital losses to offset any capital gains. And then if you have more capital losses than you do gains, which might happen, I'm talking to crypto investors maybe, up to $3,000 of those losses can be used to reduce other income. And then if you have even more losses than that, you can carry those extra losses forward for future years. So that's one great way to capitalize on what may not have been a great year for your investments. The other thing I like to do, and this is for people, even if they don't itemize, is contribute to your traditional IRA or to a health savings account. And those contributions can be tax deductible. For traditional IRAs, it depends on a few factors. But these are really great contributions. There's caps to them, so you do have to watch out for that. But there are three things I really love about these moves. First, you don't need to itemize your taxes, so anybody who takes a standard deduction can use this. Two, they help with your retirement savings. We all know people haven't saved enough. Well, this will get you further. And three, these contributions can actually be made until tax day next year. So you don't have to do it at the end of the year. You can wait until April 18th. That's when tax day is for next year. For those who itemize their taxes, that's not as many Americans. There are a few things you can do. First of all, you can get the most out of your state and local deduction by prepaying your 2023 property tax bill. So next year's tax bill before the end of the year. And then you can, if your state allows it, and then you can use that for your state and local tax deduction. Another homeowner tip here is you can pay your January mortgage payment before the end of the year. Then that can help maximize the mortgage interest deduction that you can take. And then of course, tomorrow is Giving Tuesday. And so contributions, charitable contributions, make those for 2022. And if you plan to make some for 2023 and you want to double up to help take a bigger deduction, go ahead and do that.
And you talked about people that do itemize, as so many do not. What's the most common mistake? Look, a lot of people just say it's not worth the headache to me. What are the most common misses that people should itemize, that should take a little bit of extra time?
Well, it depends on how complicated your taxes are. Usually, the more complicated your taxes are, more likely you need to itemize. If you have a lot of capital gains, capital losses, if you have other kind of income, if you have business expenses, things like that, that's when you want to start itemizing. Also, if you had a huge health event and you have a lot of unreimbursed medical expenses, if those exceed your 7.5% of your adjusted gross income, then you can deduct those costs. So that's something to add up, and that's only for itemizers.
All right, we got to leave it there. The itemizing is never fun. I try to keep it as simple as possible. Don't even own a house, but we'll see how it works out next year for me. Coming up, Tesla's Model 3 is reportedly getting a major update. Stay tuned for details.
McCarthy will face a leadership challenge, and whomever becomes the speaker will then take on big business in a rather dramatic turn of events for the party. Senior columnist Rick Newman with us now. Rick, why is the GOP now taking issue with the Chamber of Commerce, which has long supported candidates across the country?
Hey, Dave, your mic was off for part of that
mute
intro.
Button there.
Yeah, so I couldn't hear exactly what you were saying, but I know we're talking about.
Can you guys hear him?
All right. Republicans in this.
Mute button on there, Rick. Anybody have any? All right. We'll be right back after a short break. Try to get the audio fixed there with our senior columnist, Rick Newman. Back
Guys, I
after
have the mute button on.
Welcome back. And guess what? We're going to get a market update of the day's action. All three of the majors down about 1.5%. The Nasdaq off a little bit more than the rest. Russell 2000 down about 2% there. Let's check out the sector action for the day. And here we can see all 11 sectors in the red. Staples, that was the least bad. You can see it's down about 38 basis points here. But real estate, energy, materials, and tech, all of those down more than 2%. And if we take a look at some of our leaders and sentiment indicators, let me press that one more time here, we can see only KWEB, that is a Chinese internet ETF, in the green. To the downside, cannabis not feeling the love today. MJ down about 4.5%, followed by meme stocks, ARK, and chip stocks. But let's take a look inside the Chinese market here, as that has been in the news with all those protests that we were seeing over there. Pinduoduo talked about their earnings earlier today. Blockbuster 2 quarters in a row, that's up 12.5%. NetEase up 2%. Trip.com up 8%. Over the last month, guess what? We've seen a lot of these stocks really just take off and fly. Now, have they recovered a percentage of their yearly losses? Yeah, I would say so. But Alibaba is still down 36%, JD.com down 28%, and you see some of the damage that is in the sector as we sit here. Now, let me take a look at the crypto market. We were talking about some of the failures that we've seen there before. This is futures. We're going to talk about the crypto here. Bitcoin down 2%, didn't have the best weekend. And let's take a look at the 5-day price action. You can see overnight just getting ahead of that BlockFi bankruptcy filing that we got earlier today, really just hovering above the 16,000 level. And if we put a 3-year chart on, just want to show you some of the damage that has been done to the crypto sector right here. 20,000, let me put a 5-year chart on. 20,000 was the high back here over in I think it was the end of 2018, 2017 in there. Well, guess what? We have now fallen below that and we're just chopping below. So what does this mean in the longer term? Probably going to have an extended crypto winter. Not the best news, but as long as these fallouts, as long as these shoes continue to drop, and as long as the Fed remains in extreme hawkish mode, as we have seen today, probably not going to get a different picture. Here's our travel and reopening picture. Not surprisingly, seeing a lot of red. Ironically, some of the green spots do come with those China exposed stocks. Trip.com, that is a Chinese travel company, up 8%. And Wynn Resorts, of course, with exposure to Macau, that is up 4%. Now, let's take a look at the bond market. And inside, this is the S&P 500. Let's take a look at the 10-year T-note yield. Not a lot of action today. We did see that close up about 1%. The 30-year down just a smidge. And the 13-week, well, that has been the one to watch. That closely tracks what the Fed has been doing over the last 3 months. You can see that has basically risen by 50% of its value. Don't really see that often. And here's what's really been catching my radar today, the U.S. dollar index. This is over the last 3 months. By the way, the 200-day moving average sitting just below here, and we have risen off of that. So if the dollar were to continue to climb here, probably going to put a damper on any kind of Santa Claus rally. If it sinks below finally, and it hasn't today, but if it does, probably going to watch out for that to finally give some love to equities in the grand old month of December. We're going to be right back after this.
Balenciaga, for those who don't know the brand, think about this preposterous $650 Simpsons t-shirt or their true piece de resistance. These dirty, tattered, beat-up old shoes that retail for nearly $2,000. Well, now the high-end luxury brand has hit a new low. An ad campaign featuring children posing with BDSM teddy bears. Yeah, that's bondage. And if that's not offensive enough, the background displayed legal documents featuring the Supreme Court ruling on child pornography laws. In an attempt to skirt accountability here, Balenciaga has actually filed a $25 million lawsuit against the production company and the set designer. Now Kim Kardashian, a brand ambassador for Balenciaga, says she's reevaluating her relationship with Balenciaga, adding she was shaken by the disturbing images. The campaign has been pulled, but the questions remain. Should Kim K and other celebrities be more careful with their endorsements? Kardashian should at the least disassociate herself with the label if she wants true change. And what about Tom Brady, Giselle, Steph Curry, Larry David, Shaq, all named in a class action lawsuit involving Sam Bankman-Fried's now bankrupt FTX? Well, nobody blames them for taking easy money, but they must accept that there are very hard consequences when things turn south. Being an influencer is a massive luxury in our celeb-obsessed culture and carries with it a weighty burden. Just like the football field and basketball court or even Kim K's influencer space, you cannot hide when things get tough. Kim was very late to play this and still not strong enough. And we bring in Ali Canal to further this conversation. Ali, we, the consumer, can also vote with our wallet when it comes to Balenciaga. And though they are blaming the production company and the photo and the photographer, everyone else, we can vote with our wallet here as well. But what about the celebs involved?
Well, David, first I want to say snaps. Very, very passionate that you were. I agreed with everything you were saying. And it's interesting because you constantly hear that these companies need to be really careful with who they choose to partner with because these celebrities, these influencers, you have to do your research. But the opposite is true as well. And in today's social media world, in today's cancel culture, you cannot stay silent on these issues. Now, Kim Kardashian did eventually respond, but it took her days. It took her days, and many people said it wasn't enough. I'm very skeptical if she will actually end this relationship with Balenciaga. We know how committed she is to the fashion world. If you're watching the Currencies and the Kardashians, she's very proud of her relationship with Balenciaga. So that remains to be seen. I do think this is going to be a storyline in an upcoming season of the Kardashians, but I definitely think there is a responsibility for any influencer, any celebrity. If you are attached to that brand and you've promoted it in a public setting, you need to address it when things get tough. It's not easy, but it must be done.
This is why I do not keep up with the Kardashians, and I largely stay off of social media. The Thanksgiving holiday, though, can be a good time to head to theaters with the whole family. Allie, and who are the winners and losers this weekend box office trip? We got 4 days in there. I don't know how they're counting them, but lots of excitement.
Lots of excitement, but more losers than there are winners. But I'll start with the good news, right? Let's start with the winners. One winner definitely has to be Knives Out Glass Onion. That sequel is a Netflix streaming exclusive. However, we did have this theatrical run for 1 week. Only 600 theaters, so it wasn't even available in every single state or city. Yet despite that, reports have it pegged between 12 to 15 million over the 5-day holiday period. Now, Netflix did not release these figures. This is all based on reporting. Netflix said it will not be releasing the official box office numbers. Perhaps that will change considering the success here, but it begs the question of whether this film should have had a longer theatrical release, whether Netflix should reevaluate its relationship with the box office and perhaps roll out more of these films for a longer period of time. So that was a winner. Then we had Disney, which was a winner and a loser. We had Wakanda Forever in its third weekend, consistently doing well yet again, another 64 million over the 5-day. But then its animated film, Strange World, despite an A-list cast that included one of my faves, Jake Gyllenhaal, that only grossed 18.6 million over the 5-day. And this movie is set to lose $100 million over its theatrical run. And Disney certainly not happy about that, especially considering all the problems that company is going through right now. Other films like Devotion, The Menu, Bones and all grossing below 10 million. And it was just a very disappointing Thanksgiving holiday, even less than what we saw last year when there were less movies out.
Yeah.
So it's going to be interesting to see how the holiday season does at the box office and going into the first quarter of 2023.
Originally thought it was a terrible idea for Netflix, just being honest, but it looked like it succeeded in that it makes a lot of people want to see that once it's on Netflix. Gave it a lot more attention than it would have had otherwise. So it looks like a success. Ali Canal, thank you. Good stuff. We'll be right back after this break. The red wave expected to sweep across the country was more of a small ripple, albeit one with rather large implications within the Republican Party. It is expected that Kevin McCarthy will face a leadership challenge, and whomever becomes the speaker will then take on big business in a rather strange turn of events for the party. Senior columnist Rick Newman here to tell us why. Rick, the GOP against the Chamber of Commerce, what's the deal?
Yeah, and I think the way this is going to play out is just through hearings that the Republicans will now control in the House of Representatives, whether McCarthy is the Speaker of the House or somebody else is. But they're going to make a big show probably of calling up some CEOs of so-called woke companies that overtly support liberal social causes or different types of ESG measures. And they're going to try to embarrass them and see if they can gain some traction among the anti-woke voters out there. And I'm not 100% sure it's going to work. So Ron DeSantis had pretty good success with this in Disney, in Florida with Disney and a couple other companies when they came out against the so-called Don't Say Gay law. But the rest of the country is not Florida, and members of Congress are not Ron DeSantis. So, you know, the reason that companies behave the way they do is because they're getting a lot of pressure from other constituents who want them, to focus heavily on good governance and get on the right side, whatever the right side is, of certain social policies. And Donald Trump, let's remember, he was not shy at all about bashing companies when he didn't like what they were doing and basically severing those old links between big business and the Republican Party. And Trump lost in 2020, and his candidates did poorly in 2022. So I think what's going to happen is Republicans are basically going to be testing if anti-woke capitalism actually works.
Yeah, I would have thought the trial balloon on that popped with the midterms. Be interesting, though, to see how Bob Iger might have handled that situation down there in Florida, but we'll never know. Rick Newman, good to see you, sir. Thank you.
Hi, guys.
Tesla is developing a new version of the Model 3, according to a new report, codenamed Highland. The redesign is rumored to bring a number of changes to the electric sedan. Yahoo Finance senior autos reporter Praz Supermanian has more. Praz.
Yeah, Jared, this is a kind of a much needed update for the Tesla Model 3, which has surprisingly been out since 2017 without nary an update. We've probably seen a couple of things under the skin, but nothing major. What Reuters is reporting is that Tesla is going to probably update the exterior styling, potentially the powertrain and battery, and likely that touchscreen display that's very popular with customers. And it sort of sets the car apart with the kind of minimalist and digital sort of cockpit there. One of the things that Tesla will do is reduce costs of building the car by probably reducing complexity and also using larger cast moldings that we've seen them use in the Model Y, for instance, to kind of reduce the number of parts. So, Reuters also says that this car might come out in 2023 of Q3. We'll probably see that first in China, then eventually, potentially at Fremont here in the United States.
Interesting. And Praz, Chevy unveiled another EV. What can you tell us about it?
Well, this one is going to be in China, Dave. It's the Chevy FNR XE. It's funny because GM does not have an EV sedan in the States or one coming as far as we know, but they're going to do it in China because in China, apparently the sedan sort of body type is still very popular there amongst the people there. It's a very sharp looking car you can see there, both literally and sort of figuratively, right? So really kind of some of the new design language of Chevy EVs potentially here, looking at this with the FNR XE. No specs yet, but reports in China suggest it'll come out probably next year. And this is big because 2023 is a big year for GM with regards to its EV onslaught with stuff like the Equinox, the Chevy Silverado EV, and also the Blazer as well.
All right, got to leave it there. Praz Supermanian, thanks as always for that report. All right, Dave, a number of movers, catalysts today, but it started out with China. We had some Fed speakers, but your big takeaways with respect to that grand country over there that we need so much.
Well, the protests spreading to now, I think, 7 or 8 cities across the country, really pushing back against the strict COVID lockdowns, COVID zero policy. My strange question is, I think these will largely die out. I don't think they have enough momentum. I don't think they have enough people involved in them. But I can't help but wonder if companies like Apple will start to rethink production, rethink the supply chain. We got a glimpse at the conditions of the iPhone factory there in China, and it ain't good, Jared.
No.
Now, we like our iPhones cheap and we like them quick, but I can't help but wonder at some point if the consumer will choose they want to be on the side of human rights. Probably not. We probably want them cheap and fast. But will Tim Cook think otherwise?
Yeah, I think it's all a question of what gets covered and exactly what the fallout from there is, but we don't know enough, and really the media reports have been scant so far.
Right.
All right, that's going to do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for coverage of all your favorite market movers into the closing bell and beyond.